Not yet, Ajay. Maybe
Hmm.
I need to do it sometime.
Okay, you're not much of a EV follower, is it? Okay, how are you playing this, energy transition slash EV, or some other part of the renewables in your portfolio?
So, Ajay, we find reasonably good opportunities in that whole EV transition or clean energy space within the listed space. Currently, if you look at the automobile sector, the penetration of EVs in passenger cars in India is very small. It's just about less than 2% of the overall market. So, for example, we have a holding in Tata Motors, and they dominate the EV space in passenger vehicle segment. But apart from that, there are bigger opportunities in auto ancillaries. A lot of Indian auto ancillaries are supplying to global EV makers, and they have a meaningful part of their business coming from global EV makers. So we own some of these auto ancillary companies which are riding on global EV wave or theme in that sense. And apart from that, when you talk about clean energy transition, we also own companies like, let's say, Inox Wind, which essentially is into setting up wind power capacities and plants for companies. And on top of that, we also have exposure to utilities which are setting up renewable capacities across wind and solar. So we are playing it across the whole value chain in that sense, Ajay.
Okay, wind and solar, that's the full value chain that you're going to be playing as well. Pankaj, good afternoon. This is Vinny joining in the conversation as well. And now, since you're with us, I know you do like a lot of new age tech companies as well. Now, we've not seen good days at least coming in as of now for some of them as well. When you talk about Nika, Paytm, nothing in much in terms of an interest that is there on the positive side as of now. What's your thought on these companies? Anything specific that you would pick up other than Zomato that is looking attractive then?
So one, Vinny, our overall hypothesis remains that the entire internet sector in India, which is about roughly about currently about 5% of India's GDP. So will become India will become a $1 trillion internet economy by the turn of this decade. So this sector will grow at high teens to 20% kind of a thing over the next 8 to 10 years, which effectively means the growth opportunities for companies in these sectors are very significant because consumers are transitioning and having incremental, significantly higher adoption of digital goods and services. We own some of these names you mentioned, like Zomato and Paytm. Apart from that, at this point of time, we are equally constructive on InfoEdge, which is the parent company of Zomato, and which also becomes a pseudo play on Policy Bazaar and their core businesses across job search uh, and 99 Acres, which is a property search engine. We also like some of these logistic companies like Delivery, which again are on the an ancillary to this internet company in terms of handling logistics and express parcels for these companies. So overall, sectoral hypothesis remains intact. Different stocks might behave differently depending on the valuation and earnings growth and so on and so forth. But directionally, we continue to remain positive on the whole space as a whole.
Sure, that's interesting. Pankaj, any ideas that have emerged in the recent correction within the small and mid caps or anything which is now looking like good value?
So we're turning, Aisha, pretty positive on the whole generic pharma space. We think that prices in US have started stabilizing, and from whatever data I get to see, I believe at some point of time, later part of this year or next year, we'll actually see start witnessing generic companies recording price increases. So we like companies which are the meaning US generics market has been a big pain for global pharma companies, but we think that headwind will actually turn into tailwind and it will become supportive for companies in terms of their earnings growth. So companies which are leveraged or over-indexed to the US generic space is what we like. Within that, we own companies within large caps. For example, we own Sun Pharma and Zydus Life Sciences. We own amongst the mid caps companies like Alembic and Ipca. So that's one which is looking pretty promising from the next 2 to 3 years perspective.
Okay, Alembic is what is looking attractive as well, and other names as well. Pankaj, let's talk about some of the consumption story, right? Overall, in the consumption pack, when you look at it, we've always spoken about the K-shaped recovery in the last few quarters. But today, when you have to play a consumption story right now, what would it that you would be looking at? Would you start seeing some of these FMCG names which have not done well, or would you still continue to play on the higher end of the discretionary side or the fashion and retail side of the consumption story?
So let me lay out my view on the whole consumer space. If you look at it, last 4 years post-COVID in this bull market, the biggest underperforming sector actually has been consumer. My view is consumer as a sector might have cyclical upswings, but the sector will underperform during the course of this decade because this decade, India's recovery or growth recovery is led by investment cycle. So investments are leading the growth, and consumption will underperform. And on top of that, obviously, the slowdown in the consumption has got accentuated in the last 12 months because of one, poor monsoon, secondly, impact of higher inflation hurting income levels of rural consumers. And also there was some degree of over shopping or overbuying which the consumers had done post the unlocks that happened post COVID. So combination of three, we've had a very serious slowdown in consumer over the last 12 months. In fact, my conversation with companies and people on the ground or companies on the ground and dealers and distributors still give us a feelers that things have still not picked up significantly on consumer side. We're hoping that probably if we have, probably the base case assumption for us is that we'll have a normal monsoon this year, and we should see some cyclical recovery in the consumer sector in the second half of the year. Having said that, we are very clear from a portfolio and investing perspective that we don't want to own any of the staple companies in the consumer side. If at all we want to play consumers, we want to play just consumer discretionary. And that could be across manufacturers and some retail companies or apparel companies which we own in our portfolio. So our bias is clearly towards consumer discretionary because when consumer spending comes back, we think we want to play the consumers who are migrating from lower income to higher income. So, and we want to capture the higher wallet share. Consumer discretionary companies are the companies which will capture the incremental spending of consumers. So, for example, last 12 months has been about services, hotels, and tourism. So, likewise, we think as and when there's a revival in consumer, we want to capture the incremental wallet share of consumers. So, we would like to play consumer through consumer discretionary. We don't find growth or valuations attractive in consumer staples. So, we've just stayed away from that, and we'll continue to do that.
Right, Pankaj Murarka is still conversation with us, and Deepan Mehta is also joining us this afternoon. Pankaj, I wanted to talk to you about two ends of the market which have just not participated in the last, say, 2-3 years. One is FMCG, we all know, the anemic volumes. But what happened to FMEG? You know, the RR Kabels of the world. Polycab, we know, met with an accident recently, hasn't recovered much from there. But there are so many other stocks as well. Both these underperforming pockets, FMEG and FMCG, which one are you more comfortable getting in right now?
So, Ajay, if you look at durables, consumer durables, it's the same story out there. There's a sharp slowdown across the board, across the spectrum in all segments of consumers. And the slowdown is much sharper in goods versus services. Consumer services are doing well. Consumers are opting to more of services than buying of goods. And as I said, partly it's impacted because of inflation hurting their consumption levels. And secondly, probably there's been overstocking or overbuying, which has been done in 2021 and 22 after the unlocks. Consumers are going more after experiences, which is what I'm seeing in all the anecdotal evidences where they want to take more holidays. So travel companies are doing well, let's say airlines. Hotels are doing pretty well because consumers are traveling more and so on and so forth. There's some part of this durable companies when you talk about companies like RR Cable and Polycab, which comes from the industrial part of the business, which is the cables, industrial cables. That part of the business actually has done well, and that's again a reflection of industrial capex picking up. So that part of the business has done well, but anything that relates to consumer has actually underperformed, or there's been a slowdown in growth, which is visible clearly now almost for the last 4 quarters.
Of the stocks and sectors that we've talked about, anywhere that you may have added in the last month and a half?
So two things then. One, clearly on every dip you want to buy into industrials. I think the India's investment cycle will only gain further strength and momentum with every year gone by, because so far investments have been largely driven by public investments or government investments. I think as we see data or I see data, there's significant amount of private investments pipeline which has been built over the last 12 or 18 months. And many of these projects will hit execution in terms of hitting the ground over the next 12 to 18 months. So we'll see a very, my expectation is that we'll see a sharp revival in private sector capex also, which has been missing for almost a decade. I've been saying this for a long while. So one, I think overall growth for industrial has been actually the fastest growing sector over the last 8 quarters now. And I think this economic cycle that India is undergoing, industrials as a sector will continue to lead India's economic recovery. So companies within the sector will grow at a rate significantly higher than overall our aggregate GDP growth. Apart from that, we are betting on IT. We think we are at the last leg of IT slowdown. From here on, probably this quarter, March quarter, will again be moderate in terms of revenue growth, but we'll see margin improvements in all the companies. More importantly, from second half of this next financial year, I think we'll start seeing growth coming back because many of these companies are sitting on strong order book, and I think client spending gradually is coming back in US, and it will only improve going forward. So IT is another sector where, for a slightly longer term investor like us who takes 3-year view on stocks and businesses when we invest, from a 3-year perspective, we find risk reward very attractive or fairly attractive in IT. So IT is another sector where we've been adding exposure.